of leases. So Part E is accounting for operating leases by the lessee. So we've already finished two examples. IFRS and ASPE of capital or finance leases for the lessee. Or I should have lowered that down. Just like in class. So now we're looking at the operating leases. So for ASPE, if the risks and benefits are not transferred, so those three criteria we looked at on the other page or in the last video, if there's no to all of them, then it will be treated as an operating lease. For IFRS, we're going to treat everything as a capital or finance lease unless it's short term, so less than 12 months, or low value assets. So in that case, basically you're debiting rent expense and crediting cash. Now, it could be prepaid rent and accounts payable. It really depends on the question. So just watch that. Exercise 2016 is one that looks at the operating lease, so you can go through that and do it. Total expenses over the lease term are the same regardless of the accounting method, but the timing of expenses is different. Capital leases, because we're using the effective interest approach, are going to have higher expenses up front, lower expenses later. And you can read about that last part. So that's operating lease. You pretty much, it's like when you pay your rent or you lease an automobile. You debit an expense, you credit cash. That's it. And again, depending on the timing and when the year end, put it into prepaid, and then at year end, adjust prepaid. But you know all that because you've done adjusting entries in intro and in 350. So the rest of the chapter is all about the lessor, the one that owned the asset in the first place. So, from the lessor's point of view, there's three types of a lease. Operating, so ASPE calls it operating, so does IFRS. And IFRS will look at the page 8 classification system. Like ASPE. We'll talk about that in a second. Then there's the finance and caps, and we're talking from the lessor's point of view. There's a finance type lease or there's a sales type lease. And ASPE calls it sales type or direct financing lease, whereas IFRS calls it manufacturer or finance lease. The main thing here is with this sales type lease, show a profit above cost. And remember, with these, they've transferred the risks and rewards of ownership. That's okay. Just talking to the dogs. You guys can come in. Okay. So more specifically, how does the lessor determine whether the lease is a capital or finance lease or if it's operating? So IFRS, they use the same criteria as the lessee under ASPE. They also add a fourth item. Is the item unique? So if you're leasing a very unique machine that no one else has, then that would be part of a criteria that says, you know, it should be a capital or financing lease. Now, for ASPE, the lessor uses the same criteria as the lessee. And again, those are on page 8 in case you're looking for them. but they add two extra criteria. One, the credit risk associated with the collection is normal. Remaining unreimbursable costs to the lessor can be estimated. So these have to occur. If those if those criteria aren't met, it's going to be an operating lease. So sales type and financing type leases are capital leases, okay? But the difference is whether or not there's a dealer's or manufacturer's profit. If there's profit, then we call it a sales type lease, so we'll do different calculations. One thing that's kind of neat is under ASPE, a lease may qualify as a capital lease by the lessee and an operating lease by the lessor. In that case, both companies actually carry the asset on their books and depreciate it, which is kind of a unique situation. Okay, I'm going to stop this one here because I've got one short little video to do E and F. Bye.